Good morning. Your valued CPA is here to give you some important updates based on the one big beautiful act that was signed into law on July 4th, 2025. It made several things permanent from the provisions of the 2017 Tax Cuts and Jobs Act. And today I'm going to go into several of these items. And I'm going to create a few of these videos because I want to make them a little bit more relevant to specific groups of people. And at the end of the day, what I want you to take away from this is that individuals that don't have businesses and business owners that file individual tax returns will also have benefits. And this is an extraordinary win. So I'm putting on my blinders so that I am only talking about tax impact. And right now I'm only talking about the positive tax changes because there are a few income phase outs that are going to affect what I'm talking about. So I do need you to consider speaking to a tax professional so that they can consider your very specific situation. However, at the end of the day, this is an extraordinary bill that is going to change your life in a positive way at a very minimum for the next several years from 25 to 28. And for some individuals, it'll give permanent relief in certain situations. So, what I want you to take away from this is the fact that this is one of the first bills and times in tax history, at least from my perspective in the last 20 years that I've been in this industry, that this bill allows us to reset in a positive way. What do I mean by this? What I mean is if you do nothing this year, okay? Let's say you do nothing because you don't know what to do and everything stays the same for you financially as it was in the prior year. If everything stays the same and you do nothing, you're still going to win. You're going to win because there are some changes that I'm going to dive into that are just going to save you on taxes and you're going to have more cash flow and you're going to be able to reinvest that back into your business, or you're going to be able to reinvest that back into your employees as a retention tool, or you're going to be able to just take that vacation that you desperately need, or potentially create a legacy for your kids so that they can also create wealth as they age, as they grow, and as you grow and your business grows. Okay, so now that we know that this is kind of rare, I want you to take a deep breath and a deep pause so that when you're dissecting what I'm telling you or sharing with you, you have the tools in your back pocket so that you can have the discussions with your tax professional if these items pertain to you. So, one of the big things that is permanent is that the current individual tax brackets are locked in. The 10%, 12%, 22, 24, 32, 35, and 37%, they're locked in. So that's kind of off the plate, and that is going to set that baseline so that you kind of know where you stand, even if nothing changes. Okay, and then I'm going to talk about quite a bit of our time with the itemized versus standard deductions. So the IRS gives you a standard deduction every single year. And if your standard deduction is higher than your itemized deductions, you're able to take your standard deduction. Your itemized deductions is a separate animal. Your itemized deductions would be any medical expenses that you had that are over 7.5% of your AGI, real estate taxes, state withholding, mortgage interest, charitable contributions. There's more things, but those are the major ones. If the combination of your itemized deductions exceeds your standard, you're able to itemize. So those that have the standard deduction, it was increased if you're single to 15,750, head of household 23,625, and married filing joint, $31,500. That's a win in itself. Now, if you itemize, there's a lot of magic happening here. When you itemize, the big win came from the SALT cap increase. What is the SALT cap? The SALT cap is state and local income tax. And the combination of your state payments, your state withholding, plus your real estate taxes, those two combined, they were capped at $10,000. So it means if you paid $30,000 in state income tax withholding and $10,000 in real estate taxes, that would be a $40,000 total. However, you were only able to deduct $10,000. So you lost $30,000 that you paid, meaning it wasn't a benefit, a tax benefit for you. Now, if you are single, the 10,000 SALT cap still remains. Okay. But if you're married filing joint and have an AGI below $500,000, that SALT cap has increased to $40,000. So this is going to be a huge, huge win and tax planning opportunity. This is one of those situations where I said with this SALT cap increase, and with the itemized deduction increase, just by doing nothing, you're going to save on taxes. So that's where I'm going here. So what does that mean? If you make over $500,000, if you're married filing joint, there's a phase out period for that SALT cap deduction. So that will have to be factored in your tax planning. So make sure you remember that. But if you make less than $500,000 and you're married filing joint, that SALT cap increase to $40,000 is going to be a huge benefit to you, especially if you live in high income tax states like California, Illinois, New York. There's a lot of other ones, but those are our primary ones where we kind of set our tax code because those are going to be the biggest tax savers for you. For those that live in Florida, for example, we don't have an income tax interstate, so it doesn't give you such a huge benefit, but it will benefit those that live in high income tax states. So good for you. Congratulations. If you do nothing, you're going to save on taxes. Amazing. Okay. So charitable deductions are also a part of your itemized deductions. So in the past, if you donated to charity and you had mortgage interest, real estate taxes, essentially all those items, if they exceed your standard deduction, you would itemize your taxes. This year, charitable deductions, if you're single, you can deduct up to $1,000. And if you're married filing joint, up to $2,000, even if you take the standard deduction. So what does this mean? This means that the BBB allowed charitable donations up to $1,000 if you're single or $2,000 if you're married filing joint to be above the line deductions, meaning they're in addition to your standard deduction if you don't itemize. So if you don't itemize, you'll still benefit because before the BBB, if you didn't itemize and you made charitable donations, you didn't get the benefit of it. Now, this is also very important for those that do itemize and make a charitable donation. There's going to be a 0.5% AGI floor. So that will also factor into those calculations. So essentially, because you're able to take $1,000 or $2,000, depending if you're married or married filing joint or single, above the line, they reduced by 0.5% the charitable donation deduction on your itemized deductions. Still a win, but I wanted to accentuate that as well. Okay, since we're talking about itemized and standard and above the line, the other really, really interesting update is that, I'm going to pull this up because there's actually quite a few items that factor into this. But now the BBB introduced a new temporary deduction for auto loan interest. Okay? Auto loan interest. for US assembled vehicles. Okay, so what does this mean? It's above the line, so you don't have to itemize. You could take advantage of this if you take the standard deduction, just like you can still take advantage of your charitable donations if you take your standard deduction. Your auto interest, it is available to both itemized and non-itemized filers. It applies to new vehicles with final assembly in the US. Okay? It could be a car, minivan, SUV, pickup truck, van, motorcycle, all-terrain or recreational vehicle used for personal purposes. The vehicle must serve as collateral for the loan. That's kind of obvious, right? You get a car loan, you're collateralizing your loan with the vehicle. And it covers vehicles purchased in tax years 2025, 2026, 2027, and 2028. The deduction is capped at $10,000. And of course, there's an income phase out. I'm not going to go into that phase out in this call, but make sure you understand that with your tax preparer. Okay. A few more things here that are going to help individuals significantly. Okay. Because Trump wasn't successful in getting all of Social Security for seniors to not to be taxable, there were two things that came out of this. Before, up to 85% of your Social Security was taxable, right? If you exceeded certain AGI limits, meaning if your total income exceeded certain limits, up to 85% of it could have been taxable. Now, only up to 50% of it will be taxable. And in tax years 2025 through 2028, so 25, 26, 27, and 28, each senior who's 65 years or older will get a 6,000 personal deduction on their taxes so that it reduces their taxable income. So it's temporary relief for a situation where he couldn't get 100% of your Social Security to be not taxable. So he at least got some of it reduced if you're 65 or older and you have that personal deduction that you could take advantage as well. So this will be really important for those that collect Social Security, that still own businesses, that make income, that have part-time or full-time jobs, and have other styles of income coming in. So this will be important for you. Once again, if you do nothing, you will save on taxes this year, which is super, super important. All right. Child tax credits increase, which is amazing. So the more kids you have, yes, there's phase out limits, et cetera, but your child tax credit has increased. And then there's two things for W-2 employees, which I want you to pay very close attention to, because at first glance, it seems like it's, oh my gosh, all my tips and all my overtime pay is not going to be taxed. That's untrue. All right. There's qualified overtime pay. Qualified overtime pay. You're going to have to talk to your employer about what that means. Okay. So your qualified overtime pay up to $12,500 will be reduced from federal taxes if you're single, and up to $25,000 if you're married filing joint will be reduced from taxability, but it's not all overtime pay. So it gets a little bit complex, and I encourage you to talk with your employer about that. And qualified tips are also exempt from federal income up to $25,000 per year. And once again, it's qualified tips, not all tips. So be careful with the terminology. I don't want you to be misled. And I want you to have all the tools in your back pocket so you know how to approach this. Once again, everything that we just talked about, if you do nothing, you will save on taxes. So congratulations. This is really, really good news. A few other things that I'm going to touch upon are your QBI, the qualified business income. If you have an S corporation, right, up to 20% of your S corporation profits will go into the calculation, and you're able to reduce your taxable income. by your QBI deduction, by that 20%. And I won't bore you with the history, but the reason this was created in the first place was because C corporations, the maximum taxability is 21%. So instead of everybody changing their S corps into C corps, right, which that was the mindset of business owners several years back when the QBI was introduced, it allowed those that had profits in the S corp and are under certain thresholds of AGI to be able to reduce 20% of their taxable income with this QBI deduction, and they didn't have to do those C corp conversions. Okay. So it allowed them to not have to jump ship that quickly. So the QBI is back and it's permanent. So once again, if you do nothing, you're going to save on taxes. Okay. If you're in a situation where you're selling your business stock in a C corporation, this is beautiful. It's called the 1202 exclusion. If you hold your C corporation for 5 years or more, you get a $15 million capital gains exclusion. There were talks that it was going to be 20 million, and in the past it was 10 million. But as of the BBB, it is now 15 million, and it gives you a tiered option as well. So after 5 years, 100% of your 15 million capital gains is excluded from taxability. If you hold it for more than 3 years, it's 50%, more than 4 years, it's 75%, and then obviously 5 years or more, it's 100%. So that's going to be a really important tax planning tool. If you already have a C Corp and you're looking to exit, excuse me, if you already have a C Corp and you're looking to exit, or if you're creating a business with an exit in mind, getting into a C corporation structure and following these rules will be a huge benefit to you when you exit your business between years 3 and 5, ideally at year 5. So once again, if you don't do anything, you're going to save on taxes. All right. Another really interesting thing that came out of this were the adoption credit is now permanently refundable. Okay. So if you are adopting that, that's good news for you. And there are new thresholds for 1099s. And I'm going to get into this a little bit because these thresholds are actually going to save a lot of business owners time and money and frustration. And first, 1099Ks. So those are your third-party payment processors, right? The IRS wanted the threshold to be $600 for third-party networks, and the BBB got rid of this and is restoring the previous threshold that if a third-party network collects payment on your behalf, you will get a 1099K if the threshold of payments is $20,000 or more per year and 200 transactions. Okay. So 20,000 and 200 transactions. So that's a major win, especially for those that are casual sellers and gig workers and you don't have a formal structure, but at least this will help you out significantly. Also, what's really interesting that the 1099 MISC and 1099 NEC, meaning non-employment compensation thresholds increased. So independent contractors or vendors that are required to receive a 1099, and we can do a whole other podcast on that, the reporting threshold is being increased from $600 to $2,000 in the calendar year beginning in 2025. So this threshold is going to essentially, well, one, it's indexed for inflation, but also it's going to help business owners because a lot of people get paid in the $600 to $1,000 range, right? So you won't have to issue 1099s to them. There's exceptions to that. So pay attention to the podcast that will come out regarding 1099s, but it is increased for up to $2,000. So this will be a huge, huge, huge benefit for you. All right. I am over the next several weeks, I'm going to be inviting some professionals to discuss some of the other changes, specifically with some new investment opportunities and the ability to create kids' savings accounts and the ability to grow wealth, especially with crypto and especially with your increased 401k limits and a few other changes that are coming about. But I want to make sure we have that conversation with someone that's looking at this from the financial perspective as well. Keep in mind, I told you today I only have my tax blinders on. I'm not looking at this from a wealth preservation yet. Because speaking of wealth preservation, the estate and gift tax exemption doubled as well. So that's going to be a huge opportunity for you. So I'm going to save a few other keynotes for future podcasts, but I wanted to leave you with a few of these items because at the end of the day, the big takeaway is if you do nothing, this is a reset year and you will save on taxes. Now, I don't want you to do nothing. My recommendation is take your time to understand what changed. Talk to your tax professional, talk to your valued CPA, and take a moment and take a breath to design your plan so that you can take advantage of all these tax changes and some asset protection opportunities and some wealth planning opportunities so you set yourself up, your business, and your family for success. I hope this helped. I hope you have a gorgeous day, and I'll see you on the next podcast.